All right, what is up, tycoons? What's up, traders? Super excited for today's video. We're going to give a review of Q1 of 2023. We had a super bullish first quarter to start off the year. We're seeing almost the exact opposite of what we saw in 2022, with a lot of the laggards actually being the leaders. We're going to break down some of those things, as well as go over a couple things about the economy as well. Make sure to smash that like button and subscribe to the channel if you guys are new. Shout out to Simply Wall Street. That is today's sponsor. It's a really great platform that I've used for a while, and now they're officially a sponsor to the channel. We'll go into them more, all right, later in the video. Before we go any further, the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear on this YouTube channel are not registered financial advisors or brokers. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer. And we're going to go ahead and start off going over Q1 and taking a look at the NASDAQ, the S&P 500, as well as the Dow Jones. Q1 of 2023 is officially wrapped up, and it was a positive one for U.S. stocks. The NASDAQ led the way, rising 16.77% year to date, while the S&P 500 advanced 7.03%. The Dow Jones posted a more modest gain of 0.38% over the quarter. Q1 marked a remarkable recovery for the growth-heavy NASDAQ, which finished 2022 down 33.1%. So already we're seeing 16.77% gains year to date after a really bad and rough 2022 for the NASDAQ. Now the Dow and the S&P 500 both rebounded to a lesser degree, bouncing back from 2022's negative 8.8% and negative 19.4% returns respectively. And if you take a look at our chart here, okay, we can see that the NASDAQ is in the lead. All right, we have the S&P 500 and then the Dow Jones lagging a little bit, but still green, okay, still positive on the first quarter of the year. Now, when you look at the asset class performance, the table below shows the performance of asset classes over increasingly longer look-back periods. I'll get my head out the way a little bit so you can see here, but all but one asset class was positive in Q1 of 2023. The U.S. growth outpaced all asset classes with a 14.4% return, followed by the World ex-USA's 8.2% return and the S&P 500 7.5% return. Commodities was the only laggard, posting a negative 4.9% return. Now, commodities actually being down so much is not a great sign. Now, we're actually going to take a look at the 10-year, 2-year Treasury yield as well. And, commodities combined with the 10-year, 2-year Treasury yield, these typically are recessionary signs, right? Recessionary signals, and they are flashing right now. I'm sure if you're watching anything finance related, there's a lot of warnings related to, a possible recession coming. And these are some of the reasons why we're seeing those. Now, as we mentioned in that chart, you're seeing U.S. growth in the World ex-USA leading the way with the S&P 500 right behind. All right. Major technology companies helped lift the S&P 500 and Russell 1000 growth index. For example, Apple, Microsoft, Amazon, nvidia, and Alphabet are the top 5 holdings in the S&P 500. Specifically, nvidia had a meteoric rise to start the year, gaining 90% in Q1. Not to mention all of those other companies had they also had double-digit gains in Q1. Now, NVIDIA has been an absolute powerhouse, right? Not only did they crush earnings, but AI has taken the world by storm, and NVIDIA is one of, if not the top AI company out there. A lot of people are familiar with ChatGPT, but they don't realize that, these companies, they need AI compatible, chips, right? They need, the chips that are really going to be able to allow these AIs to run. And NVIDIA is a powerhouse in that sector and in that segment. Now, quick shout out to today's sponsor, Simply Wall Street. Okay, if we actually go over and we take a look right now, what we can do is we can look and we can go over to the Simply Wall Street website. All right, they also have a beautiful app, but I am recording this on the computer right now, so we're going to go to the website. All right. And Amazon just reported earnings, right? And what's really great, what I really love about this company is I post a lot of technical analysis. Simply Wall Street is like the ZachlyTrades of fundamental analysis, guys. It gives you really, really simple fundamental analysis. It breaks things down for you guys really simply. All right. It'll give you an overview. All right. And then you can actually go through here, take a look at some of the competitors. All right. And it will compare the financial health, the value. You can see the price history and performance. It also gives you a bunch of the recent news and updates surrounding whatever stock you're looking at. All right. What I really like is this factor over here. It subsidizes everything into 7 categories, right? So we can click on the valuation and take a look at the valuation score for Amazon. It's got a 5 out of 6, right? And each one of these individual valuation scores, you can click on them further and they give you great, beautiful graphs, right? So even if you're not perfect at understanding fundamental analysis, it really breaks things down super simply for you guys. And it'll also compare things to its peers in the industry, which I really, really love to see that. Based off of the Simply Wall Street, you can see that Amazon is a good value based on its price to sales ratio compared to the peer average. All right. And you can take a look at some of the other ones that are in negative territory, right? And in the red right here, and kind of showing a little bit of warning signs versus Amazon is in the green right here, right? You can also take a look at the financial health. We can see Amazon has a 4 out of 6 on the financial health. Let's say we want to dive into, the X's here, right? And really see what are some of the things we might want to be concerned about Amazon. We can simply click on that and it'll go over it for you, right? If we look at the short-term and long-term liabilities, Amazon's short-term assets of 136.2 billion do not cover its long-term liabilities of 162.3 billion dollars, right? So you can really dive in a lot deeper, and Simply Wall Street does all of the work for you. So there's going to be a link in the description and a pinned comment below. If you guys use my link, you will get 14 days, all right, a 14-day free trial to really explore the system. It's super amazing, guys. There's much more that you can do, all right? There's also a stock screener. You can link a portfolio to this. You can create a watch list. You can discover different things. But to highlight some of the more things right here, you can even go into the management side of things, and it'll show you the management criteria checks. Amazon gets a 4 out of 4. You can take a look at the ownership and it'll break down the ownership for you, give you some of the insider trading. It'll give you the ownership breakdown right here. So the general public gets about 31% of the shares, and institutions have about 59.1%. It breaks down the rest there for you guys with individual insiders, different things like that. You can also discover new portfolios and new ideas through their Discover tab, guys. It's really great. They have an investing ideas that really goes over many different things. It's a great platform, a great resource. Again, there'll be a link in the description. All right. You can use that link and you guys will go ahead and get 14-day free trial. Now, the first 100 people to sign up using my link can actually receive up to 40% off of their Simply Wall Street membership. It's really not expensive, guys. I don't mind paying the fee, and I'm glad to have them as an official sponsor to the channel now. We'll go ahead and dive back into our presentation that we've got for you guys and move on forward. All right, the 10-year, 2-year Treasury field hits record lows. Is the economy in trouble? The 10-year, 2-year Treasury yield spread, which measures the difference between the yields on the 10-year and 2-year Treasury bonds, has been inverted since July of 2022. An inverted yield curve can create significant challenges for banks and other financial institutions, leading to a credit crunch and decreased consumer spending, which can further weaken the economy. Now, we're literally seeing these things happen right before our eyes, guys. All right, we're seeing significant challenges for banks. We've seen Silicon Valley Bank, we've seen Silvergate Bank, we've seen Credit Suisse. All right, and the most recent one is going to be First Republic. I've actually got a video coming out next week on the banks that I think could be the next Silicon Valley and First Republic. They could be really massive short opportunities. So make sure to subscribe to the channel so you guys don't miss out on that video next week. Now, with the exception of the brief recession in 2020, historically, a negative 10-year, 2-year spread has been a leading indicator of a recession. Now, I also mentioned commodities, right? We took a look earlier, and commodities were one of the only sectors that was down, if not the only thing that was down in Q1 of 2023. And that's also an indicator of a possible recession coming. With the 10-2 spread hitting its lowest point in over 4 decades in March of 2023, investors and economists are left wondering, could a recession be on the horizon, or will the economy prove resilient? And we can see the S&P 500 here in purple, and we can see the 10-2-year treasury yield spread here in orange. And these shaded gray areas, these are recessions, okay? Now, what's really important to pay attention to, guys, which a lot of people don't realize or don't emphasize if they talk about the yield curves, is the recession happens after we uninvert. So you can see that we're the most inverted we've been in a very long time. But after we uninvert is typically once you get the recession, right? Over here, we're inverted and then we uninvert. That's when we head into that recessionary period. Inverted here, we uninvert. That's when we head into the recession period. Uninverted, reinvert, or we're inverted, then we uninvert and we head into that recession period. So that's what you guys really need to be cautious of, right? Is, we are seeing them inverted right now, but we may not be actually seeing the worst in the economy. That could happen actually when the yield curve uninverts. So that's something you definitely need to be cautious of. I really appreciate y'all making it this far. Feel free to email me at ZachlyTrades@gmail.com. If you enjoyed this video, I do one-on-one sessions via Zoom. So you can email me, request a one-on-one session. If you guys would like some analysis on some specific stocks, if you guys would like some specific market insights at things that I'm looking at right now, or if you're a beginner to trading and you would like to help me, or you would like to have me help you set up your screen, maybe you want to learn how to set up some of the different indicators and patterns that I use whenever I'm doing technical analysis. Again, feel free to shoot me an email at ZachlyTrades@gmail.com and we can work on booking a session with you guys. Once again, appreciate you making it this far. Smash that like button, subscribe to the channel if you guys are new, and I'm out.